Now, before we begin, we just want to review some of our recently posted content from this week, from last week's discussion and from other presentations. We had this discussion of the collar structure versus covered call, comparing the risks and the known risk of a collar versus the downside protection one might expect with an in-the-money covered call position. We took a current look at the market sentiment tool with the strong buys that started to appear last week as the market slipped further into its decline and slipped a little bit more this week as well. We talked about the risks on a debit spread position that should be profitable. A Bear Put Debit spread as it's going in your desired direction, but because of increases in volatility, why prices aren't matching up to where you can close out early for the return that you were hoping for. We also had a discussion on 2 ways to manage a bull put credit spread. We might look at one of those again today. And of course, we talked about general credit spread discussions, calculating return and analyzing, of course, the different structures and analyzing the different management techniques. So that's all available for public on YouTube. You could check that out at any time. All that being said, we're going to navigate over to the Power Options suite of tools now. Now, I had a couple discussions this week. You see, well, we're at the market sentiment tool right now. Last week, we were seeing a very bullish buy. We're still showing a bullish buy right now. It's going to update for us probably in the next 15 minutes or so. So we'll check back on there and see if this adjusted anymore. We have no bullish sentiments at this time. We have seven bullish sentiments at this time, 6 neutral, and no bearish sentiments. We'll see if that changes. We did see a slight uptick today in the market, 2.4% on SPX, 1.7 on the Dow. And VIX is kind of returning back to normal for us. So not normal, but it is easing off a little bit from those 33, 34 ranges that we saw earlier this week, and a little bit flirted with it last week as well. So the volatility is coming down a little bit, market settling down after the reaction that we've seen over the past 10 days, I'd say, as well. Going back to that discussion that we had a couple weeks ago, when we were talking about the 2 ways to manage a bull put credit spread, comparing what we call the pendulum adjustment versus what we might look for just rolling down the short option or rolling down the whole spread. I wanted to make some clarity here. I had a couple coaching sessions this week with investors looking to adjust bull put credit spreads that weren't actually as bad as I thought. Most of them weren't actually as bad as I thought they would be with the market decline that we've had. But a couple of them were out of range, right? They were below both strike prices. And I wanted to address that real quick because the pendulum adjustment we discuss works best when the stock is trading between the 2 strike prices. Once a stock falls below both strike prices in a bull put credit spread, it's very difficult to adjust the position using the pendulum adjustment or any adjustments if you're near that 75, 80, 85% of the maximum loss on the trade. Simply rolling down the spread won't work unless you increase the strike differences, which is going to increase the margin and the risk if the stock keeps going down, or you increase the number of contracts for the new spread that you're trading, which again is going to increase the margin requirement and increase the potential loss if the stock continues to go down. But I'm going to take this example here with BERY just because it's a stock I know and it's trading right at about 67. And what I want to do is just take a quick look at the stock chart here. We're going to find a date back in time. And this time frame looks really good. Let's go to a 1-month chart. And I like where this is at about 73 here, right before the big decline in the last 8 to 10 days. Of course, it took a big hit. Of course, a lot of positions did. And that's right around January 19th, January 18th. This stock does not offer weekly options. We're going to look at a standard monthly position for a specific reason. And we might go back to another example. So we're going to look at Barry around January 18th. And we're going to look at the historical option chain when the stock was trading right at around $73, $72 or so. And we're going to look at a quick spread based on those historical numbers that I probably wouldn't have entered because I doubt it had the probability I wanted, but we're just going to use that to show potentially an example that I think should work, but I could be wrong. Let's go to the chain. Of course, we're on our trial account here, so I'm going to see puts only. And we're going to go back in time. During the trial, you have 3 months access to the historical backtesting and the historical option chain. We're going to go right back to the 18th. Okay, and the stock was at 72.14. And I'm sorry, I want to go to February, which was 31 days out. Again, we don't have weekly options on this particular stock position. Yeah, so this is only a 62% probability, so I wouldn't have done this one. But let's go ahead and take the 67.50. We're going to take the midpoint, and we're going to say on January 18th, we sold the 67.50 February put for 110. And at the same time, we're going to buy the 62.50 for 58 cents. We're going to use a 5-point spread in this case on Bear position. And it's going to give us a decent net credit for a 5-point spread. Let's go ahead and build that in the custom spread tool. We'll type in our stock here. We'll go to February. We'll select our options, our 67.5 put, now slightly in the money, and our 62.5 put as well. We're going to use the historical data from January 18th, the sell to open at 110. We're going to buy to open our 62.5 put for 58 cents. Oh. All right. So this is a reasonable bull put credit spread, 11.6% return. 52-cent net credit at midpoint on a 5-point true risk. For a true risk, actually, $448 of this position went against me. As we can see now, the strike is trading between our strike prices, just a little bit below the short option. Now, 2 reasons I wanted to show this particular one that's just slightly out of the money. It had a higher probability, 72%. Using the 70 strike was at 63% on January 18th probability, so we probably wouldn't even have looked at that as an out-of-the-money credit spread. All is not lost. Let's add this to the portfolio very quickly so we can see a bird's eye view. I'll just put it into the spreads, January 21st. Let's go ahead and enter it into that one. And let's change our date to the 18th. My apologies. All right. So the reason I want to put this into the portfolio from the custom spread tool is I want to see what the loss is right now. And let's see. We talked about how the maximum loss was 448. Right now, we'd be losing about 136. So, yeah, about 33% or so of the maximum risk in this case that we're losing on this position. This 260% is showing me the amount of loss I'd have right now compared to the hoped for initial net credit of 52 cents. And if the stock stays where it is all the way to expiration, we'll still have a profit of $5. But we know the stock's going to fluctuate a little bit more up or down between then. Okay, so I'm not quite at my 50% loss, which would be around $220 for this position. We're at about a 33% loss of the maximum risk we could expect. Now, in this case, a pendulum adjustment might work. And what is the pendulum adjustment? Because I have time left remaining on the trade, it's out to February, but even if I had 5 or 10 days left, I might be able to consider a pendulum adjustment when the stock is between the strike prices. If I only have 1 or 2 days to expiration, this adjustment is probably not going to work. And if it's below both strike prices, this adjustment is not going to work. What we do in a pendulum adjustment is we're going to leave the short option where it is. We're going to sell to close our lower strike put in the bull put credit spread at 62.5. We're going to keep the same 5-point difference, and we're going to swing this out to a 72.5 put. We're going to sell to close our existing bought put, and we're going to buy to open this higher strike put. We're going to swing this here like a pendulum, and what that's going to do is in one move convert our bull put credit spread into a bear put debit spread, which will have profit if the stock continues to move down in price. You could also do this if you were in a bear put debit spread, for example, and the stock started to go bullish and you wanted to flip it, you could convert the bear put debit into hopefully a bull put credit if the numbers work. So let's just see first if a pendulum adjustment would work in this scenario. What do we have to do? We have to sell to close the 62.5. I'm going to click on it again to add it back in. I'm going to keep the same 5-point difference, add in the February 72.50, And if the numbers work out, it doesn't look like it's going to. It did. So what have I done here? I was in a bull put credit spread initially, where the stock has fallen below my short put strike price. I'm at a loss of about $133, which was about 33% of the original 448 maximum risk expected. We took our 62.5 put and swung it up here to the 72.5, keeping a 5-point spread. We're now in a debit, which cost us $448 to enter this Bear Put Debit spread. So as long as the stock stays below that short put strike price of $67.50, what happens? Well, essentially, we're forced to buy shares of stock on the in-the-money put at $67.50, but we can force someone to buy it at $72.50. We get 5 points back, so we make a max profit of $52, almost the same as that initial net credit that we received. This is an adjustment that might be able to work if the stock has fallen between your strike prices. Let's go back to our initial position. Another adjustment that could be done in this case, since I did leave a strike between, that's why I chose the 5-point strike for this example, the $67.50, and buying the $62.50, because I left the 65 in the middle. If I think that Barry has dropped about as far as it's going to go and that it's settled down and it might start to move back up, well, yes, I can leave the 67.5 put alone and hope that recovers. But if I'm concerned that it might drop a little bit more, I may be able just to buy to close the short, which will be expensive, but then sell to open one strike lower. Just move the short put down one strike price. So what we would look to do here, of course, again, is we're going to buy to close the $67.50, and we're going to sell to open the 65. This doesn't look like it's going to work with only initially that 52-cent net credit, but we'll see. So we've got a buy to close it here. Look like it's around 270. And we're just going to roll down. Let's call it 293 here. And we'll call this, this is the sell to open, so we'll call it 177 without the rounding. Yeah, so this one, in this case, didn't work. Sometimes you'll see that you can roll down one strike if you leave a strike between and still have a profit. Maybe about half of what you originally expected. We looked originally at 11.6% return on this theoretical Barry bull put credit spread that's now being threatened. And if this works, I would expect that the max new return by rolling down just that one strike price, if it was available, would probably only be about a 5 or 6% return. What's the benefit of it? If it did become a profit, I would give myself another $2 or so of room before the new put is threatened. And I still kept a positive return in the case that it settles down and starts to move back up in price. So it's just, another 2 ideas that might consider when the stock breaches the short put strike price. Now, very quickly, let me do this here. Let me go back to our historical chain on Barry very quickly. And if I could get to that properly. I know you're seeing the same screen right now. I'll be right there in 1 second. And so what I want to do now is I want to see the worst position I had mentioned initially on January 28th. What would we have done if we had taken that riskier position when the stock was at 72 for the February expiration instead of using the January, of course, to give ourselves more time? There we go. All right, so we're back to the chain now. And again, I'm sorry, we're on January 18th, Barry at 72.14. The 70 strike put was at 273. Again, I wouldn't make this trade because it only had a probability of 59.1%. Oh, I'm looking in March, and I was wondering why those numbers didn't look right. Let's get back to February. My apologies. Fantastic. The 70 has a 62% probability, which I still was too low. But here we see the 67.50 at 110. So we could sell to open the 70 at 185, buy to open the 67.50 for 110. Going to give us about a 75-cent net credit, nice round number on a 2.5-point spread. It's going to be a very high return position. But again, it doesn't have the probability we would normally look for. We'd usually like to be further out of the money. This is just for an example on the position. Let's go back to our custom spread. Let's put in this other Barry at the money trade for February. Selling the 70, and I'm keeping only a 250 spread here because I want to show an example where the stock is below both strike prices. And we're going to sell the 70 at 185, buy the 67.50 at 110. There's our 75-cent net credit. True risk of 175, so we're looking at about a 42.9% return, but as you saw, we only had a 62% probability of success, and the stock is now below both strike prices. So this is the situation where normally, even though I have a lot of time out to February, this doesn't work. Here, let me go this way. Here with a very similar pendulum adjustment, we saw the one that would work when it was between the strike prices, just a little bit below the short put. Here we may attempt to do the same thing, where we'd sell to close our 67.50, swing it out. We're just going to keep the 2.5 points here to 72.50 to try to create a profitable Bear Put Debit spread. But once both options go in the money, and these aren't even that far in the money, it's usually more difficult for this to work. What you usually see is positions that, just like we saw with adjusting one and staying in a bull put credit, we've rolled ourselves into a losing position. And that's a lot of the ones that 2 of the 3 discussions we had this week of investors attempting to use a pendulum adjustment when the stock had moved now 6-7 points on $100 stocks, $200 stocks below both strike prices, and their expiration is coming up on February 4th perhaps, or even this week. It's too close. It doesn't have enough time. Your 2 options that are now in the money are getting closer to intrinsic value where the pendulum doesn't work. But with more time out to February, 21 days remaining, if this was our trade, let's see if the pendulum would have worked in this case. What are we going to do? We're going to sell to close the 67.50, leave the sold put where it is. Keep the same strike difference, go up to the 72.50 put. Sell to close the original one we bought, and buy to open the new higher strike. And I want to erase these numbers here. So this is the buy. Oh, no, this is the sell. So 292. And there we go. There's the buy. Let's just put that in. Okay, so this one did work out okay, but notice how low the return is. We dropped from a potential 42% return. Now that it's gone this deep in the money, the return dropped to only 2.5% on the position. $12 return on this particular spread. So it still does work, but it's because we have time remaining. If you're under 5 or 6 days to go to expiration, the stock is below both strike prices. What you'll typically see trying to apply the pendulum adjustment is that you'll be locking yourself into a loss. It might be less of a loss than you'd currently take if you liquidated the spread right now. But again, there's no chance for profit on that position. And if that stock recovers, then you're in a situation where, you're in a situation where you could actually lose more to the upside in that case if the stock starts to go back up against you. All right. So I just wanted to review that real quickly. Some of the concepts that we teach in that webinar, the 8 ways to manage a bull put credit spread. The pendulum can be very powerful, but it's not a cure-all, and it usually doesn't work once the stock is trading below both strike prices.